The Strait of Hormuz just went dark. Commercial transits. Single digits. Brent is at $90 and WTI is holding 84. But the real story isn't the price, it's what Saudi and the UAE are doing right now to bypass the blockade, and the EIA data that could send oil into a melt-up or a liquidation event within hours. I've got 3 specific trades mapped out, including a scalp above 85.10 and a swing setup at 83.20. This isn't a prediction, it's a battle plan. Full breakdown is live on the channel. Don't trade this market without watching first. Let me paint you a picture of what just happened in the global oil market because the headlines aren't telling you the full story. The Strait of Hormuz, the most critical choke point on the planet for energy flows, has effectively gone dark. Commercial transits have plunged into single digits. We're talking about a waterway that normally sees something like 17 million barrels of oil pass through every single day, and right now, it's a ghost highway. A merchant vessel took a hit from an unidentified projectile, engine room damage, crew casualty, and just like that, the entire energy supply chain to Asia is choking off in real time, and here's where it gets really interesting. The US-Iran ceasefire memorandum that's been holding this fragile situation together for 60 days expired without an extension. President Trump made it crystal clear. No extension, no new talks, just a rigid naval blockade that's now locked in place. Meanwhile, Brent Crude is trading at $90.91. WTI is at $84.03, both heavily underpinned by this massive risk premium that's been building for weeks. Now, I've been trading through geopolitical oil shocks for the better part of 20 years, and I can tell you something with absolute certainty. The price action you're seeing right now doesn't reflect the full magnitude of what's unfolding logistically. The market is pricing in a disruption, sure, but it's not yet pricing in a structural supply chain rerouting that's going to take months, not days, to resolve. So here's my weekly verdict on crude oil. I am bullish, but with a very specific caveat. The trend is undeniably your friend here. We are looking at a 3.13% monthly rebound for Brent and a 3.52% recovery for WTI. Weekly trends are showing strong bullish momentum with 2.19% and third consecutive gains respectively. But here's the key inflection point that everyone needs to understand. We are approaching overbought territory on certain indicators, and the next 48 hours are absolutely critical to MY invalidation level for this bull thesis is a daily close below $87.90 on Brent and $81.10 on WTI. As long as we hold above those levels, the path of least resistance is higher. But let me be very clear about something. This isn't a market where you can just buy and hold without a plan. The volatility parameters are elevated. We've got an ATR on Brent of $1.85, and that's high volatility territory. This is a trader's market, not a buy and hold investor's market, and here's a question I want you to ponder as we go through this analysis. If the Strait of Hormuz remains effectively closed for even another week, where does oil have to go to choke off demand? Because we saw this play out in 2022, and the answer might surprise you, let me walk you through the technical landscape starting from the weekly chart because this is where the real story unfolds. Brent Crude has put in a strong bullish rebound from the mid-80s, and what stands out to me is the way this recovery has been steady rather than explosive. That's actually a healthy sign for continuation. When you see violent spikes without consolidation, they tend to reverse just as violently. This 3.13% monthly recovery has been methodical, and that tells me we are seeing institutional accumulation rather than retail panic buying on the daily chart. Both benchmarks are trading above their 50-period exponential moving averages. That's a textbook bull market signature. Brent's daily trend is confirmed as bullish. WTI is holding its breakout zone, and the moving average structure is beautifully aligned for further upside. WTI's MA5 at $84.70 and MA10 at $83.95 are providing immediate dynamic support. The MA20 at $82.40 and MA50 at $79.68 represent the medium-term structural floor. When you see this kind of upward-sloping moving average stack with the shorter-term Mars above the longer-term ones, it's a classic bull market configuration. Now, the 4-hour and 1-hour charts are telling us a slightly different story. they're showing some momentum consolidation and minor technical pullback. This isn't a reversal signal, it's just a pause. I've seen this exact pattern countless times where price needs to digest gains before the next leg higher, and that's exactly what we are looking at right now. The momentum indicators are constructive but require careful interpretation. Brent's RSI is at 62.5, which is bullish leaning but not yet in overbought territory. We've got room to run. WTI's RSI at 58.1 suggests even more upside room, which is actually a positive divergence worth noting. The MACD on both is showing bullish histogram expansion with a signal line crossover in positive zone, confirming the momentum is building, not fading. The ADX is particularly interesting here. Brent at 28.5 indicates a strong trend, while WTI at 26.2 shows a strengthening bull trend. I like to see the ADX above 25 to confirm a trend is established, so both are passing that threshold. The CCI for Brent at 112.4 is slightly overbought, but the reading on WTI at 98.5 is squarely in bullish expansion territory. And the stochastic crossover, bullish cross for Brent at 78.4 over 74.2, ascending for WTI at 71 over 68.3, that's textbook continuation signals. The Williams percent range at negative 21.4 for Brent is flirting with overbought, but WTI at negative 33.6 is showing positive continuation. What I'm seeing is a market that's strong but not stretched, and that's the kind of setup that can fuel a sustained move higher. Alright, let's talk about what's actually driving this price action because the technicals only tell you where price is, not why it's there. And in this market, the fundamentals are absolutely screaming. The geopolitical situation is the primary driver, and I want to be very specific about what's happening because there's a lot of misinformation floating around. The US-Iran truce collapse isn't just another headline, it's a structural shift. The 60-day memorandum allowed for some limited diplomatic channels to remain open, and those channels have now slammed shut. The naval blockade in the Strait of Hormuz is being enforced with no exceptions, and what that means in practical terms is that oil tankers simply aren't getting through. Saudi Arabia and the UAE are scrambling. And I mean genuinely scrambling, to reroute exports via pipelines to circumvent the Strait of Hormuz. But here's the reality that smart money is watching. Pipeline capacity is limited. You can't just flip a switch and move 17 million barrels a day from tankers to pipelines. There's a physical constraint in the system, and that's creating a supply scramble that's going to take weeks to work through. Now, the diesel crack spread just hit a record $102.20. Let me explain why that matters. The diesel crack spread is basically the profit margin for refining crude into diesel, and when you see it at this level, it tells you that demand for refined products is absolutely torrid. We've got concurrent agricultural peak demand. We are in harvest season in the Northern Hemisphere, combined with global shipping stress from the geopolitical disruption. This is a perfect storm for the energy complex. What stands out to me is that the crude oil price hasn't even fully priced in the downstream tightness. The crack spread is screaming that the system is pinched, but crude itself is still relatively contained. That's a disconnect that normally resolves with crude moving higher to catch up. Now, the calendar for the next 24 hours is absolutely packed with market-moving events. At 2 p.m. Eastern Time today, we get the US EIA crude oil stock change report. The previous week showed a massive 17.42 million barrel build, but that was before the Hormuz situation escalated. The market is expecting a draw this time around, and if we get a number that's even slightly bearish, we could see a violent reaction. This is a high volatility alert, I cannot stress that enough. Then at 2 p.m., we also get the FOMC meeting minutes. This is going to dictate US dollar direction and macro inflation expectations, and that's going to have a direct impact on oil prices. Remember, oil is priced in dollars, so a stronger dollar could put pressure on crude regardless of the geopolitical situation. And if the minutes suggest the Fed is more hawkish than expected, we could see oil prices take a hit as risk appetite contracts. Looking further out, on August 21st, we've got global flash manufacturing and services PMI data coming out. That's going to indicate underlying global crude demand strength, And I'm watching that very closely because if we see a contraction in manufacturing activity, it could be a headwind for oil even with the supply disruption. Now let me give you the trade setups I'm looking at for the next 24 to 72 hours. And I want to be very clear, these are high-risk setups with aggressive parameters. This is not a market for passive management, scalping plan. Long bias. My first setup is for the aggressive scalper. If WTI breaks and holds above $85.10, I'm looking to execute long positions targeting $85.90 and then $86.14. The breakout trigger is critical here. We need to see that level taken out with conviction, not a fake out that reverses within minutes. I'm setting a tight stop loss at $84.65, which gives you about 45 cents of risk for a potential reward of 80 cents to $1. The risk reward is favorable on this setup, but the stop needs to be respected. If we break above 85.10 and hold for at least a 15-minute candle close above that level, the momentum could accelerate quickly. Scalping plan, short bias. My second scalping setup is for the counter-trend player. If Brent faces standard rejection at $91.50, I'm executing a short scalp targeting $90.10 with a stop loss above $91.85. This is a tight 35-cent stop with a $1.40 target, so the risk-reward is solid. But let me be very clear about something. I only take this setup if I see clear rejection. That means a bearish candlestick pattern, maybe a shooting star or a bearish engulfing, combined with some momentum divergence on the 5-minute chart. I've been burned too many times trying to pick tops in a bull market, so I want to see the technical evidence before I take this one. Swing trading plan. Buy the dip now for the swing traders, and this is the setup I personally prefer given the current market structure. I'm looking to buy the dips. On structural retests. For WTI, I want to see a technical pullback toward the $83.20 to $82.40 support band. This is where I start accumulating, with a target of $87.50. My invalidation stop loss is strictly below $81.10. For Brent, I'm looking for order entries near $89. This is a polarity flip level, meaning it was previously resistance and should now act as support. My target is structural upside extension toward $93.50. The invalidation point is a clean daily close below $87.90. Let me walk you through the logic on this swing setup because this is where my personal experience really comes into play. I've seen this exact price structure multiple times in my career, where you get a geopolitical shock, a spike higher, then a consolidation or a modest pullback that retests a prior resistance turn support level. That retest is where you want to be a buyer because that's when the institutional money that missed the first move starts accumulating. The same institutions that were sellers into the spike become buyers on the pullback. It's a beautiful structure if you can wait for it. Alright, before I move on to risk management, I want to pause here and ask you something. Which of these setups matches your trading style? Are you a scalper looking for quick hits, or do you prefer the swing trade approach? Drop a comment and let me know. I always read through the comments and I'll be responding throughout the session. Now I need to talk about risk management because in a market like this, the difference between winning and losing is often just a matter of position size and discipline. High-risk parameters are currently active. I cannot emphasize this enough. Leveraged traders should strictly utilize tight capital preservation metrics because updates regarding naval blockades can trigger instantaneous price gaps. I'm talking about gaps where price moves 20, 30 cents in a single tick. If you're over-leveraged, that gap can stop you out before you even have a chance to react. I want to share a personal experience here that shaped my entire approach to risk. Back in December of 2021, I had a position on Crude going into a long weekend. I was confident in the setup. The technicals were aligned, the fundamentals were supportive, everything looked perfect. Over that weekend, China announced a surprise lockdown that was significantly more aggressive than the market had anticipated. When the market opened on Monday, crude gapped down over $2. I was stopped out immediately, and the position size I was using was large enough that it actually hurt my monthly returns. What did I learn from that? 2 things. First, never underestimate the impact of weekend news in geopolitically sensitive markets. And second, Position sizing isn't just about protecting your account. It's about protecting your mental state. When you're overleveraged, you can't think clearly. You start making emotional decisions. You get reactive instead of proactive. That's why for this current setup, I'm using what I call news-proof position sizing. I'm sizing position so that even a $2 gap in the wrong direction doesn't take me out of my trading game. The other thing about risk management in this environment is that you need to be ready for the unexpected. The FOMC minutes could cause dollar volatility. The EIA number could surprise to the upside or downside. There could be a breaking news headline about the Hormuz situation at any moment. My personal approach is that I'm placing my trade orders with my stops and limits in place before I walk away from my screen. I'm not going to try to chase or scale in after the fact because that's when you get caught out. Let me pull it all together for you because this is where we separate the pros from the retail crowd. The key level you need to be watching is $85.10 on WTI. This is the immediate hurdle that determines whether we see continuation to 86.14 and beyond, or whether we get a pullback toward the support levels that I identified. For Brent, it's 91.70. If we take that out with conviction, 92.85 comes into play very quickly. Now here's what I want you to walk away with. The geopolitical premium in the market is real, it's significant, and it's unlikely to dissipate anytime soon. The supply chain rerouting that's happening right now isn't a one-day event. It's going to take weeks to work through. And in the meantime, the physical market is going to remain tight. But I'm also going to be watching the macro picture. The FOMC minutes could change the narrative quickly if the Fed signals that they're more concerned about inflation than the market is currently pricing. And the PMI data on Friday is going to give us a read on whether the demand side of the equation is holding up. I'll be back on Friday with a full breakdown of the PMI numbers and an updated technical analysis heading into the weekend. And if there are any significant developments in the Hormuz situation, I'll be doing a live stream to cover it as it unfolds. Make sure you have notifications turned on so you don't miss it. If you found this analysis valuable, do me a favor and hit that like button. It genuinely helps more traders find content like this. And if you haven't already, subscribe to the channel with the bell notification turned on. I'm the founder of Alpha Market Meridian, and my goal is to bring you the kind of institutional-grade analysis that used to be locked behind paywalls. Every day, I'm breaking down the markets the way I would if I were managing a trading desk, because that's exactly what I used to do for 20 years. Before I go, let me just say this. I know the markets are volatile right now, and I know it's tempting to overtrade or to chase moves. Resist that temptation. Stick to your plan, respect your stops, and let the setups come to you. And if you ever have questions about a specific trade or a particular level, drop it in the comments. I read every single one, and I'm always happy to share my perspective. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq Gamma flip later. Trade smart, manage your risk, and I'll see you in the next video.